Hey guys, thanks for joining us at Non-Del Influencers Podcast. I am your host, Nate Clear, soon to be president of First Funding, currently national sales manager. Today, it's my honor to introduce Mike Mell, SVP from Freedom Mortgage. Mike, how we doing?
Great. How are you, Nate? And congratulations on this new title. I didn't hear about this before. That's awesome.
Oh, yeah. Thank you. Thank you. Yeah. Kind of a blessing and a curse, I'd say. But
Yeah.
at any
Yeah.
rate, I'm still excited kind of for that new chapter.
It's awesome.
So for our listeners today, this is really for if you're an existing correspondent, you're going to want to tune in just to understand kind of trends that are going on more specifically in the government lending space. And if you're a broker that's just tuning into this podcast, trying to get more information on some of the benefits, we're going to dive into some of those benefits as it relates to government lending. Perhaps you're doing FHA, you're doing VA, USDA, whatever. Those are some of the concepts that we're gonna tackle today. And so who better than Mike? Mike, you and I got started, man, what was that, 2013 or so? 2013, 2014?
Yeah, 13, 14, right around there. Yeah, it's been a minute. Yeah.
Yeah.
It's been great. Come on.
We did a ton of VA business back then.
Yeah.
Which is, kind of when I was thinking about, hey, you know what, we've done so much more or less around conventional conforming. I need somebody from a government standpoint that's done a lot of government lending to come in and talk about it. So appreciate you joining us.
Yeah, thanks for having me.
So no surprise, right? Like everybody's seen here over the last 18, almost 24 months now, interest rates rising. Yeah. Have you seen with that an increase, decrease in government lending? What is that? I mean, what does that look like from?
Yeah, I think, Nate, generally speaking, I feel like government gets hit a little bit harder when rates are rising like this. There's a couple of specific reasons. One being, generally the government loans tend to be a little bit harder to get done. They're maybe not as cash flush. Their incomes might not be as great. So you have a harder time qualifying when, if you've got somebody approved at a 48% DTI and now all of a sudden rates are, 2 points higher, you kind of lose the pool of people that could have bought homes. So that's it. I think that the government loans get hit a little bit harder in the rising interest rate environment for sure.
And you're seeing that, right, naturally refinances go pretty much away, right? So that's more for just the affordability side of things.
Exactly. Affordability is big on the government lending, and when rates go up, it's a big hit. Yeah. Like you say, refinances have gone to the wayside for the most part, right? We're all in a purchase market. We're all fighting over the same loans, and not as many people qualify when rates are 2 points higher than they were 18 months ago, 2 years ago. So it's tough, and generally speaking, the government sector, those loans are just a little bit harder to get done. So when you have interest rate pressure, it makes it a little bit harder for those to get done. So I think that's why that volume and that market has shrunk more than you probably see the conventional market shrink.
Absolutely. And can you help me to kind of understand a little bit more? So if I'm using a conventional product and I put 5% down, I'm still having to pay MI. If I choose an FHA product or a VA product, where does that insurance come in, and what does that look like in comparison to conventional private MI versus this government MI?
Well, so it depends on the program. So VA, they have a funding fee that's charged, right? There's no monthly fee on VA loans, but there's a funding fee that's charged that the veteran has to pay. And that's what's on top of that. On FHA loans, you have an upfront MIP that you're paying, and you also have a monthly MIP that you're paying. So and you put down 3.5 versus 5. There's different factors involved there, but that's really the area that there's the difference. VA being the one where you don't have any monthly MI.
Gotcha. And so are brokers and lenders, are they able to offer the same government products?
They are.
Okay.
Same programs, right? That's being on the Non-Del Influencer podcast. To me, that's the beauty of being a non-del is that you can offer the same products that you're offering as a broker, you can offer them as a non-del. I mean, you know, we have at Freedom, we've got, you know, not only people doing VA loans, but FHA loans, all products, right? And it's just the same product, same thing. You're the lender. It's there's definitely benefits to it for sure.
Yeah. So I know that, you know, for VA, USDA, you don't need to change licensure, but can we talk a little bit about FHA and what changes there when you're making that transition from broker into correspondent?
Yeah. So on FHA, if you're going to be, you know, closing loans in your name, you've got to get a different approval with HUD basically, and you have to have a certain net worth, you have to have a certain approval. You don't have to underwrite the loans, and you don't have to have your own Ds on staff. The lender can still do that, meaning, you know, Freedom or any other lender like that. But you do have to get a certain approval. You have to, you know, it's a little bit more stringent to make that happen. But
Right.
you know, when you do that, you have all the advantages going along with that.
Right. And so, I mean, and for our listeners, I don't think anything's changed. Still $1 million net worth. 20% of that needs to be liquid in order to qualify through HUD. But I think, Mike, it's a really good point, because we run into a lot of folks that certainly making the transition from broker into correspondent. One of the biggest things that they appreciate about the non-delegated space is, I want to make this transition and I want to be in the most protected environment. And I think that's a big piece of the non-delegated piece. Let's let Freedom, let's let our investor take on the credit underwriting decision. So I think that's really big. And I think beyond that, even once you move into that FHA space, even if you have the $1 million, it doesn't necessarily mean that not only do you have this, you know, additional equity built up in your business, which isn't a bad thing, but you don't necessarily have to then kind of plunge yourself into the risk of underwriting.
Absolutely. I mean, in I would say even government more so than conventional, because conventional, we all know, is very AUS driven, right? I mean, you put something in, as long as you can fact check that, it's going to be good. You've got a bunch of different scenarios in government lending, especially FHA. You're doing potentially manual underwrites where you're going to bank those. Are you really going to have your own underwriter when you're a smallish company, or do you have that backed and that risk taken out of the equation altogether by the lender, somebody like Freedom or any of the other big lenders out there?
Right. So we've talked about kind of where government lending is today. Margin compression across the board, right? So there's certainly opportunity in government lending, lower down payments, more affordable, easier to qualify, et cetera. Completely understand that. What do you see as some of the limitations that are in the broker model as it pertains to government business?
Well, one thing that comes up, and it just does, is you have issues qualifying for QM. I mean, if, in other words, when you have rates as high as they are right now, and you have brokers trying to make their comp, well, that QM calculation includes the broker's lender paid comp. So if their lender paid comp is 2.5, let's say, that's included in that QM calculation. You might have situations where you've got some discount included in that. There's underwriting fees, there's all those types of things. It makes it hard to qualify in certain circumstances, and rates are very high. So that's one thing that I know that a lot of the people that make the jump to non-del for FHA, they might be non-del for VA and conventional, but they go ahead and get the approval for FHA, is to avoid that issue. Because when you're a non-del, any comp that the lender's in a secondary transaction is not included in that QM calculation. So that's something that jumps off the page at me right off the bat, is that, like, that's a big deal. So that's something that I see a lot.
Yeah. And I think we see the same thing, right? Is that it's ultimately, if I'm putting all of this on the front end, whether it's borrower paid or lender paid, right? It doesn't matter. It's still counting towards that QM. It's difficult for me to serve all the people that I want to serve, right? To provide that, hey, American dream, home ownership.
Right.
It's difficult to do that, right? And make a living and pass QM, especially at lower loan amounts.
Right. Yeah, I mean, there's all types of things going on right now. There's in the marketplace right now, there's lender LO comp questions going on out there. There's certain things out there where there's been some changes and some different ways to look at things that to me, being a non-del takes all that out of play. Like it's not there. It's a secondary transaction. You're the lender. You're running your own shop. So and the beauty of it is you have all of the benefits of being a broker still. So if you're a non-del, you still have all of us lenders out here buying for your business. You still have all of us. You're just a correspondent doing it, right? Or non-del versus a broker. So I mean, it's a win-win from that perspective for sure.
Gotcha. So talking about the doom and gloom of what we're seeing, a lot of what we're reading about here in the last, I don't know, couple of weeks has been, hey, looks like rate hikes are on pause for the foreseeable future. Maybe first quarter we're going to start seeing, interest rate cuts.
Right.
What does this mean on the other side? There's tons of affordability, right? In the government programs. Does that mean that we're going to see government lending slow down as a result of this when interest rates drop?
I don't think so. To me, it's going to pick up, and I mean, look, if rates drop, like we were talking about earlier, more people are going to be able to qualify. It's going to take off. It's not going to slow government lending down at all. You still have houses at their highest in forever, right? So, it's even if rates come down, we're going to still have some other issues that we're going to deal with at some point down the road, right? So I don't think the low down payment programs are going to go away. Those are just going to get stronger and go from there. Not to mention, I'm sure you've lived through one of these refi booms. We all lived through one in COVID, but when rates drop, the government refinance programs take off. So I mean, all this business we've been doing for the last 18 months, all that business is going to refinance because they're at elevated rates. So if rates drop a point, if we get into the sixes and maybe we get into the fives, I mean, that's going to cause a refinance action, and that all those government loans that have been done, they're going to get refinanced. There's no question about that.
So that brings me kind of my next point on the refinance side of things. When we were originally doing business together, it just seemed like Earls left and right. Can you kind of walk me through why we had so much business together and why we had such a migration from broker to correspondent in particular on that product?
Well, I mean, I think essentially those are easy to get completed. I mean, those are easy to scale up. If you could figure out how to get those in the door, those are easy to close. You can close a bunch of them and you don't have any issues. So that explains to me why that market took off, right? I mean, you know what I mean? So that's first. As far as why everybody's doing it as a non-del or a correspondent, I think it's because you have all the flexibility involved there, right? I mean, you can actually, I mean, we haven't talked about this, but your disclosures as a lender are different than what is a broker. I mean, you're showing, because really on an Earl, for instance, you're showing it as a no cost loan. Well, when you're brokering one and you're doing it lender paid, you're showing cost. Whether or not the borrower is paying for it, you're still showing that you're making X percentage. As a lender, as the non-del, you're just showing your disclosures as is, right? I mean, if you charge them nothing, there's no fee to that. So, and you're making all your money on the back in a secondary transaction. So, I mean, there's a couple of different reasons, but that's definitely part of it too, for sure.
And so is that the way, right? I mean, we talked about the government MI or the funding fee on those VAs. Generally, what we see on our side from the warehouse lending standpoint is that all of that showing up as lender credit to help offset any of those costs as well, right?
Right. Yeah. Yeah. I mean, if you're in the right market, that's what happens, right? I mean, those are really zero cost loans because there's enough rebate to pay those fees for the broker or however it works. So yeah, definitely. That's exactly how that shows up. And it's, that's why the market needs to improve to make that happen. That's why you don't see a lot of Earls right now, is because the rates just haven't dropped enough. And even if they drop to the point where you could do one, you can't really do them as no cost loans. It doesn't make a lot of sense for them to lower their payment and pay $3,000 when they're going to lower their payment $30 or $20. It doesn't make a lot of sense. Now, if it's free, a lot of people would do that, right? If it doesn't cost them anything, they would, and doesn't add to their loan amount, a lot of people would do that.
Yeah. So one of the things, that I get from, well, I guess all of us get, right?
Yeah.
Is questions around, okay, I move into this correspondent model and
Yeah.
maybe I take advantage of doing these VAs. I'm going to do them so that I've got enough credit in order to cover my compensation as well as government funding fees. I think some guys get a little too aggressive in trying to do that and maybe have inflated interest or maybe an overly inflated rate. And then they have concerns around, or early payoffs,
Yeah.
right?
Yeah.
Can you walk us through kind of like what you would say? I mean, I know you've got a number of correspondent accounts. You talk about this all the time. What's
Yeah.
kind of I don't know, is there an ethos? Is there a thought process that they need to consider? Is there a best
Yeah, I mean,
practice so
that's,
that you
yeah,
can?
I mean, to me, that's the question they have to ask themselves. They have to look in the mirror and see, right? I mean, now, if they want to close these loans at a rate that's elevated, they're asking for those loans to be paid off sooner, because if the market's not rising or flat, those loans will be eligible again in 6 months. Now, I mean, one of the positives another positive from the government sector is you kind of avoid EPOs for the most part, because they're generally 6 months, and you can't really do a refinance on a government loan inside of 6 months. So you kind of avoid EPOs, but you still have situations where you're putting somebody in a loan that probably is not the best loan. Whereas if you give them the lowest rate possible, where they can get in there for no closing costs, that's probably the better decision. So, but that's really, that's the lenders, the non-Del's decisions to make, really. But
Right.
that's different. Like conventional loans, those loans can go right away. Like they can do a rate and term refinance tomorrow, and now we're stuck holding a bag. So there'd be no reason to put them in a rate that was too high in that instance, right? I mean,
Mhm.
because you're just asking to write that check back to the lender.
Right. Yeah. I think it's a good point. And I know that's,
Yeah,
one of the questions that we got not too long ago was more around the EPOs and the risks that are associated with it.
sure.
So appreciate some of that light. Kind
Yeah,
of circling back now on those government funding fees.
yeah,
So I know that in the conventional conforming space, usually that MI can all be run as part of the underwrite that's being done on conventional. Does
no.
that change in the non-delegated channel as it relates to government?
No, I mean, it's part of it. I mean, like for instance, at Freedom, we handle all of that for everybody. We get the loans insured. We handle the payment of the fees. Now, there are some non-Del customers that are, I would say, larger, that have all this stuff in place. They have that. They handle that stuff, which is fine also. But for your guys that are just transitioning or just getting started, we do all of that for them. And I would imagine most lenders handle all that stuff for them also.
Gotcha. So
Yeah.
I don't need to go get my separate sign up for FHA, my separate sign up for VA, separate one for USDA,
Right. Yeah.
et cetera. Yeah. So I can come
Yeah.
out of the gate, essentially get set up, open up government lending if I've,
Yeah.
VA, USDA right off the bat, FHA if I
Yep.
get my HUD approval.
Exactly. You gotta get your HUD approval, and that's always that's why you see a lot of VA ERLs also, is because they're ready to go right off the bat, right? I mean, they get approved with you guys or with First Funding or somebody else, they're ready to go. They can do a VA loan tomorrow, as long as they know how to disclose or use the system, the lender system to disclose, they're good to go.
Yeah.
Yeah.
Well, I appreciate you coming on. I think it's really helpful for our listeners to understand that, it's not just for conventional conforming. This is
Right.
open to also the government space. I appreciate the opportunity insight on the differences in disclosures and how that can be worked to their advantage.
Sure.
One of the other things that, I'd be remiss if we didn't mention was when those premiums do come back, not having to, based off of comp plan, exceeding the cost for those closings, having to go back to underwriting, re-underwrite for principal reductions, et cetera. Will also save time, improve the borrower experience. So I think that that's important. So,
Yeah, no question.
So guys, for those of our listeners, Mike Mell, SVP, handles wholesale non-delegated for Freedom Mortgage. Certainly reach out to him if you're interested in more on government lending, how you can do that as a non-delegated. If you're a broker, you want to make that transition. I know Mike and I have worked closely on helping people do that effectively. So please feel free to reach out. If you need warehouse lending, of course, First Funding's here to help. Love to help you. Thanks for listening. Be sure to subscribe, follow, share with your friends and family. Non-Del Influencers Podcast. Thanks, Mike.
All right. Thanks, Nate.
Yep.